Hey trader, welcome. So win rate is overrated. Yep, I said it. If you think a higher win rate makes you a better trader, you'll already lose it. So in this video, we're going over exactly why win rate is the least important stat in trading and what you should really be focusing on. And when you focus on this, your whole trading is going to change for the better. So let's get into it. So everyone comes to me and says, Alan, what's your win rate? How often are you right? Okay, what's the percent on your system, etc. And it's usually from newer traders. I get it. I was the same. You think that a high win rate is the key to success. That's what we've been trained to do. We go to school, get high grades, pass the tests. You're going to do well in life. You're going to get that job, whatever. Okay. In trading, it flips it around. It's not necessarily about having the highest win rate, the highest grade. You can have a 30% success rate, a 20%, and still make a lot of money. You could be right 50% of the time and still make money. And that just goes in your head and you think that doesn't make sense. It's not logical, Alan. And it's not. But that's trading. It's illogical. It's very paradoxical, this trading. So yeah, let's explain why this is. So win rate is the least important stat in trading. Okay. It really, really is. It doesn't matter. What actually matters is risk to reward. Win big, lose small. If you can do that over a large sample size of trades, you're going to be very, very profitable. Okay. I used to chase that number, the high win rate, 78%, and I thought it's going to protect my confidence. It makes sense, doesn't it? The more you win, the more you're going to stay psychologically strong. It's not. It doesn't work like that. The losses actually hit harder because you're going in expecting to win every single trade. And when you do hit a few losing trades, it messes with your head because you think, oh, no, I've got this high win rate system. Why am I losing? And because you've not trained for it, because you expect to win, your psychology gets shot. But with a low win rate system, you go in expecting to lose that trade because let's say you've got a 30% win rate, you expect to lose 7 out of 10 trades on average. So you go in with that, you're not shocked. You go in with the expectation of, I can handle this instead of I expect perfection. And that's the key. So yeah, it doesn't protect you, especially during drawdowns as well. Even with a 7%, 8% system, you can still have a sequence of losses like 7 in a row. And that can really knock your confidence, especially when you think you're going to win all the time. And it's hard to get out of that. Okay. If you have 7 losses in a row, and the thing is with a high win rate system, you always go for shorter risk rewards. You go for smaller wins because that's the only way you can get a high win rate. So therefore, it takes a long time to get out of that drawdown. You're not just going to get 8 in a row wins. Trading doesn't work like that. It could be win, loss, loss, win, loss, loss. And that can be a real slug to get out of. You might have to take 20 trade before you're even out of break even. But with a low win rate system, what happens? You can have 1 trade, maybe 2, and you're out of that drawdown straight away, and plus you're in deep profit. That for me is easier to trade psychologically. You're getting out of drawdowns faster. You're expecting to lose, and all these are just bonuses for trading that are going to help you trade better. Okay. So here's what most traders are falling into this trap is convergent thinking. So it might seem like a strange word. I'm going to get into it, but basically there's 2 different approaches, a convergent approach and a divergent approach. Now, if you've been following me for a while, you'll know my handle is the divergent trader. And this is the reason why this mythology of a divergent approach. This is why I named the handle and my company that. So there are 2 types of trading systems. There's convergent and divergent. So a convergent system is usually like a mean reversion system where you're getting a very high win rate and you have lots of small wins. Now, a divergent approach is more of a trend following system and it's the complete opposite. So if you go with the trend, you'll have lots of small losses, but you'll have big wins. So what happens with a divergent approach is the big wins pay for all the little losses and lower. But with a convergent approach, you have all these small wins. But when an outlier event happens, you can have a big loss and lose all your profits. So in the long run, a convergent system doesn't really work that well. Divergent, it kind of plans for all these outlier events and protects you. So yeah, it just makes more sense to win big, lose small, focus on the risk to reward. This is an example of a divergent equity curve. They'll have them long periods of losses. Okay. They'll have lots of small losses and then they'll have these huge wins. Just like I said, I pay for all of the losses and more. And over time, you have a decent equity curve. This is how a convergent and a divergent approach works. So when the market's in a range, okay, what tends to happen is it reverts back to the mean. So when it's a certain standard deviation away from the average, okay, tends to revert back to the mean. And this is what the reversal traders play. But what happens when price starts to diverge? You can see here price, the shock, okay, the outlier event happens. And what happens? The reversals don't work anymore. So if you're trying to short this all the way up, you're losing all their profits and you're blowing up. So that's where the divergent approach works. So you'll be losing in this part, you're having lots of small losses, but then when it starts breaking out and keeps going and going, that's when you make all your money. And then eventually price will start mean reverting again. And you can start, that's when the reversal traders will start kicking in, and then small losses trying to recuperate. So convergent strategies, they focus on being right. Okay, it's all about small profits, high win rate. But like I said, one outlier event or one strong trend in the wrong direction and the whole thing collapses. These are the key differences. A divergent approach is basically a trend following system. It goes with the trend. Mean reversion systems are convergent trading systems. 90% of traders are trading convergent systems. And what are 90% of traders doing? They're losing. And that says it all. Convergent systems struggle in these bubbles. When you get these outlier events like 2008 financial crash, or let's just say there's a war on and gold's going up, all these people are trying to short it. And what happens? They lose all their money. The divergent traders, they made loads of money. They're going with that trend. So yeah, divergent trading approach is when price diverges from the price. Instead of reverting back to the mean, the fair value, it diverges and keeps going. Divergent approaches are typically lower win rates but huge wins. A convergent approach is high win rates but lower wins. And just like I said, crisis events, outlier events like 2008, divergent systems, that's where they really outperform and have mega years. Whereas convergent systems, that's when everything gets destroyed. So which one's making more logical sense right now? Is it a divergent approach where you just lose small, win big, focus on risk to reward rather than win rate? Or are you still thinking, no, it's a convergent approach, small wins, high win rate, that's what matters? Hopefully you'll start shifting a little bit now, thinking actually, I see what you're trying to say, Alan, win rate doesn't actually matter. It's actually a trap. So convergent systems, they're fragile. They rely on certainty and markets are anything but certain. And that's why I learned to trade differently. That's why I went divergent. So divergent traders, they don't try to predict, they prepare. They're accepting these small losses and they're hunting for asymmetric payoffs. And they know it's not about being right 7 out of 10 times. It's about being ready when that one big move comes. So yeah, as long as we're managing risk, okay, we're losing small. When that big trade comes, it's going to pay for all them and more, and we're going to have deep profits compared to a convergent system where they've just blown up. So now, even after 6 or 7 losses, that one trade that we get, it wipes it out and more, and takes us into a deep profit. And we get out of that drawdown faster compared to a lower win rate conversion system. So here's an example of some trades we took this year. This was on gold. And you can see here, if you look here, this is when the convergent systems would have been working pretty well. This is when a divergent system is failing. This is when we're taking loads of little losses here. And then what happens? We get this big win. It just keeps on going and going. It's paid for all the losses down here and more. Whereas a convergent system is winning lots here. And then when that shock event happens, they're trying to keep shorting this, they're blowing up and they're losing all the profits they've made down here, these little small wins. And yeah, they either blow up or they lose a large bit of the profits, depending if they're managing risk well. You know, that's why I've always thought a divergent approach is better, because these happen over and over. These are always happening, these big trends. And I don't want to be shorting this because you never know when that trend is going to end. So I'd just rather ride it and let it tell me when it's going to end. And here's just a little bit more proof. It's not just me doing it, it's my clients doing it on the trifecta approach. They're using my divergent system. We've got Paycup here. He's been trading on the stocks. He got a 32-hour trade on this one. Absolutely insane. We've got Lyndon. He made an 11-hour on a Forex. And then we had a Simran. She was trading Bitcoin, Ethereum. She got, I think it was 22-hour or an 18-hour on this one, and then started locking it in. And there you go. Win big, lose small, risk to reward. So that's the edge, in my opinion. Risk to reward, divergent system. That's the real holy grail. It's not trying to get a high win rate. So I break down the edge a bit more about how I trade if you're interested, how I catch these big moves, a bit more about the philosophy. If you want to watch that, I'll either post it on here or put it in the description below so you can watch that. And also, if you want to learn more about my approach as well, how it all works, the breakdown, I'll put a link down below as well that you can click on and have a watch. So yeah, nonetheless, thanks for watching this video with me. I appreciate your time as always. I hope it helps you, hope it helps shift things a little bit. And yeah, thanks for watching. Don't forget to like, subscribe, hit that notification bell, and I'll see you in the future videos. Take care. Bye-bye.